Hey everyone, today we're going to have another long video that is going to be filled with valuable content. Most of you associate debt with something negative like credit cards or student debt. Some people are still paying their student debts even though they have graduated years ago, but their student debts are still hunting them down. But what if I told you that debt isn't as bad as you think? What if I told you that debt can be something good? What if I told you that debt can be used to make money? Rich people across the globe use debt to make not just millions of dollars, but rather billions of dollars. But how do you do that? That's what we'll find out in this video. Here are 17 ways to use debt to make money. There is going to be a table of content in the description, so you can skip to the parts that you want to learn or come back and rewatch them again. This video is a combination of many of our previous videos. So grab a drink and some snacks, hit the thumbs up button, and enjoy the video. Have you heard the phrase, "Debt is the root of all evils. Never get into debt. Debt is slavery." And that is true to a certain extent, because when you're drowning in debt, your life is over. While you're trying to pay your debts are not waiting for you. They're growing day by day, since no one lends money for free. There is always an interest. Despite all of this, the United States has embraced debt. Total US consumer debt is almost $15 trillion, which brings the average household debt to over $5,300. The US GDP is a little over $21 trillion, which means the entire economy consists out of debt. But I have some good news for you. That isn't always bad. That is unpopular opinion because most of the debt we have is bad debt. You probably have some credit card debts, a car loan, and maybe a student debt, and you're thinking, it will take me decades to pay off all of these debts. How on earth can debt be something good? In order to understand how debt can be something positive, let's take a look at how people with deep pockets still use debt to make even more money. It might sound a bit confusing because why would anyone with a lot of money use debt in the first place? That is supposed to be used by people who do not have money. But that's not how capitalism works. Debt is a powerful tool if you know how to use it. And in this video, you will find out how rich people use debt to make even more money. So give this video a thumbs up and let's get right into it. Number 1. Most of the trade is based on debt. It might sound a bit controversial because borrowing money to start a business is a horrible idea, and personally, I would never do that. But there are businesses, especially traditional businesses, where using debt is your best option. Let's say you want to sell pens. It's a very common product and there's pretty much always a demand for it. Ideally, you would fly to China, find a factory that produces that kind of pen with good quality and the right price. You would purchase a container of pens, ship them to the US, and distribute them to your clients. But today, that's mostly done online through websites like Alibaba, unless it's a more complicated product where you have to fly to that factory. But here is the catch. You don't really have to pay for the products to have the product first. Let me explain how. In the past 50 years, China has become the factory of the world, producing literally everything. Thousands of factories work non-stop to produce everything that the world needs. And in order to make it easier to sell, most of these factories would gladly loan you their products in return that you would pay them sometime in the future. Of course, they would not lend to strangers, so you will have to build some kind of trust with them first. But that's how business has been running for the past 50 years. Once the client would sell the product in the US or any other part of the world, he would pay the factory and borrow more products. You're basically telling the factory, you know how to produce it, so let me help you sell it. If I can sell it for anything above this price, that's going to be my profit. What makes this strategy great is that you're not tying up your own money in this transaction. That's why selling is one of the greatest skills you can ever master. Number 2. Refinancing. Real estate debt is the best kind of debt because it's filled with loopholes. If you don't have a mortgage, then you're paying extra taxes. Rich people always have multiple mortgages to be able to get all of those deductions. Remember, every dollar that you're supposed to pay in taxes, but instead you save, is an extra dollar earned. So that's another way rich people get richer. But let me give you a more practical way. This is how basically rich people get rich in real estate. Let's say you saved $200,000. That's a lot of money. But if we're going to be honest, that's peanuts. You can't even buy a house. Of course, you can't get a mortgage up to $800,000 since you have to make a 20% down payment. But here is the secret. Let's say you find a property that costs $500,000. It's in a bad condition and needs some or maybe a lot of renovation. You head to a bank and get a mortgage by making a 20% down payment. Let's say you're going to spend around 10% of the total cost of the house to renovate it, or around $50,000. You head to your bank again, but this time to refinance your mortgage. When you got your first mortgage, the value of that property was just $500,000 because it was in such a bad condition that no one wanted to live there. But since you have renovated it, now there are people who want to rent it out. So the market value of that property, let's say, rises to $700,000. Like the first time, let's say you're going to get an 80% mortgage. But 80% out of $700,000 is $560,000. $400,000 out of that money is going to go to your first bank that gave you the first mortgage. And let's deduct another $50,000 that you spent on renovation, and you're going to be left with an extra profit of $110,000. You made $110,000 using debt, and you're left with a property that you can rent out to build equity and generate passive income. On top of that, you're going to avoid paying taxes because you have a mortgage. This is a very common practice among real estate investors. Can you really say after this that that is bad? I will leave that for you to answer in the comment section below. Number 3. Hedge funds. Hedge funds are made by the rich for the rich to make rich people richer, and they usually use unpopular strategies. Mortal people like me and you, we make our best efforts to predict which companies are going to grow and rise in value and invest the money we worked so hard to earn in hopes for these companies to grow. But hedge funds often use a completely opposite strategy. They try to make money when companies fall or go bankrupt, as it was with the case of GameStop. Although in that case, the internet challenged hedge funds and pushed them to lose over $13 billion. But how do hedge funds make money with debt? Let's say you expect a certain stock to decline like Facebook because you know that Apple, who produces the most popular smartphone, will announce next week that they will no longer let apps to track you like Facebook or Instagram track your online activity and make privacy their first priority, which will greatly damage Facebook's business model. So you pick up your phone and call your broker to borrow from him a single Facebook stock that costs, let's say, $100 and instantly sell it in the open market for $100. Congrats! Now you have $100 in your pocket, but you still owe your broker one Facebook stock. Let's say you are right, and next week Facebook stock price drops to $70. You use that $100 to buy one Facebook stock for $70 since the price dropped and return it to your broker and pocket the difference. Congrats! You've made $30 out of a fall of a stock. It sounds simple in theory, but it's extremely difficult and risky in practice. What happens if you're wrong? What if the price doubles overnight? You still have to return that single Facebook stock to your broker and pay interest for borrowing that stock. Now you have to buy that stock back for $200 to return it to your broker. When you buy a stock and try to sell it when it rises, the maximum that you can lose is the amount you invested in, but not in the case of shorting. If the price keeps rising, your losses keep rising. Theoretically, you can make unlimited losses since theoretically the stock price can rise indefinitely. But if you have 100 analysts working for you, you can make a fortune using this strategy. Number 4. Forex. We have already discussed this in our Forex video, which link I will leave in the comment section, but here is how it works in short. Forex is a market where currencies are traded. It makes international trade possible. You can't use US dollar in China. You have to buy Chinese yen to pay your employees, for example, in China. So there is a market where anyone or any company can come in and purchase foreign currencies. And based on different factors, these currencies fluctuate. For example, the Fed raises interest rates. That will limit the supply of dollar in the market and make US dollar stronger against other currencies, or vice versa. So if you can predict which currencies will rise or fall, you can make a lot of money in this market. But what makes these markets so different from the rest is that for every dollar you use to trade in Forex, you can borrow an additional $100. That means if you trade using your $1,000, you can hold a position worth $100,000. If you end up making a small profit like 1%, it will be huge. Number 5. Credit score. As you can see, debt is a powerful tool. Every successful business, company, or entrepreneur uses debt in various ways, especially if you have a proven business model. Borrowing money to finance purchase orders is practiced pretty much by every business. So stop thinking in terms all debt is bad. Of course, debt with a high interest rate such as credit card debt is horrible. But in order to get a lower interest rate, you have to minimize the risks of loaning you money. How do you do that? You build a track record of being a reliable borrower. There are billions if not trillions of dollars in the banks waiting for someone to borrow them. And even if there isn't any money, banks can create money out of thin air, and we have explained that in a previous video. In July of 2012, Mark Zuckerberg financed his $6 million Palo Alto home that's 3 miles away from Facebook's headquarters with a 30-year mortgage. At that time, he was 28 years old and world's 40th wealthiest person, worth an estimated amount of $15.6 billion. The question is, why would you get into debt when you have billions of dollars and can easily afford it? If he wanted, he could easily buy a dozen $6 million homes in cash without batting an eye. So why get a mortgage? The answer is long and complicated, but in short, it's free money. Sounds ridiculous. Who would give you free money when you are already a billionaire? Let me explain. It all has to do with interest rates. The inflation rate in the US is 2.5 to 3%. So any money you borrow that's below the inflation rate is considered free money. Zuckerberg's mortgage rate is just a little over 1%, but it's adjustable, meaning that based on the circumstances, the rate could possibly go up for one reason or another. If you do the math, the bank is losing money since the mortgage rate is below the inflation. You don't have to be genius to do the math. For the sake of example, let's say you borrow $1 million at a rate of 1%. The average rate of return on the savings account is 2.4%, meaning that if you deposit that $1 million in another bank, you end up making $24,000 a year, while you only have to make a monthly payment of $10,500 to the bank that lent you that money. Imagine if you can do that with $100 million, or how about $1 billion? When you can borrow money for free, there is no point in tying up your own money when you can use that money for more profitable things. Of course, when you are talking about small amounts of money, this might not make sense because the difference isn't that big. However, when it comes to large sums, playing around with 1, 2, or even 0.5% could potentially mean dozens of thousands of dollars, if not hundreds. Let's say you are a businessman and you can easily afford $1 million house. Why buy a house when you can finance it for 1 or 2%, while you invest the rest of that money in your business that could potentially get you 10, 20, if not 30% returns? Even if you're lazy to find a more profitable way to use money, just throwing it all into an index fund can be much more profitable, especially when we are talking about 20 or 30 years. Historically, an index fund has shown to have an average rate of return of 8%. If you take a mortgage and invest your money in an index fund, the percentage difference will end up in your pocket, It all comes down to opportunity cost. Economically, it wouldn't make sense for Zuckerberg to buy the house in cash when he has been offered a 1% mortgage rate. But he is not the only one who is so smart to do that. Take Elon Musk, for example. Most of his wealth is tied to Tesla and SpaceX. To buy a house for $20 million, he probably might need to sell a considerable chunk of his wealth, pay taxes, and incur other expenses. However, he can take free money and keep his monthly payments under his budget. He took out a $61 million mortgage for 5 properties in California with a monthly payment of $180,000. That's not unique to billionaires, by the way. It's also practiced by moderately rich people like Jay-Z or Beyoncé. They took a mortgage to buy their $88 million house. They put 40% down payment and financed the other $52.8 million. That leaves the couple with $150,000 of monthly payments. In comparison, the national median home value is around $200,000. Instead of tying up $53 million in a house, he definitely knows where to invest it to maximize his profit. At the end of the day, he has made a lot of great investments and he's on his way to becoming a billionaire. The richer you get, the better ways you find to make more money. But let's be honest, not everyone gets such a low mortgage rate. Nationwide, it's around 3%. But even at that rate, it still doesn't make sense to purchase a house if you can finance it. However, wait a second, let's make this clear. Why do the super rich get a lower rate in the first place than the rest of the country? First of all, when you're a billionaire, the bank can sleep calmly because no one is worried that you might default on your loan, and in case if something happens, you can easily sell part of your business to pay back your mortgage. That takes out the risk out of the equation. Now compare that to an average employee who could get sick and not be able to work or just lose his job for one reason or another. Secondly, paying your mortgage on time every month helps you build and maintain a healthy credit score. So when you're in trouble next time, with a strong credit score, it will be much easier to borrow money from the banks. You're basically building trust between you and the financial institutions. But it also could be the other way around. Banks do offer such a low mortgage rate to establish a strong relationship with rich people so that when their companies would need a loan from a bank, they would come to them and not their competitors. It's a win-win situation. But these low mortgage rates are adjustable, which means, as I said earlier, they could go up. But no one is worried because if it stops making sense economically to these ultra-rich people, they can easily pay back their mortgage. But most people associate that with something negative because we usually borrow money that we can't afford for entertainments and end up paying a lot more back. In fact, right after getting out of college, you realize what a burden your student debt is already. And once you calculate how many years you have to pay back that debt, you immediately create a perception that debt is bad, especially when you can't even default on it. Playing around with debt is not easy. You are eventually taking a huge risk, and a small miscalculation can lead to disastrous consequences. In fact, we've got into so much debt that most people can't even afford an unexpected $500 bill because we have to make all of these monthly payments. However, that's what distinguishes bad debt from the good one. Debt can ruin your life, make you homeless, and cripple your family if you're reckless. But it also can make you unbelievably rich if you know how to use it, because it's leverage. Leverage is a superpower that can make you rich instantly. Let's say, for the sake of example, you buy this house for $10,000, go to the market and sell it for $11,000. Congrats, you just made a profit of $1,000. However, that's not much. But if you use leverage, you go to the bank first, borrow $990,000. With your additional $10,000, that's going to be $1 million. You head to your supplier and buy 100 phones now for $1 million. Turn around and sell it to the market for $1.1 million. But you still owe the bank, so you go back to the bank again and return them $990,000 that you borrowed earlier. and another $10,000 in interest. Now you're left with $100,000. After you deduct your own $10,000, you're left with $90,000 of pure profit. That's how you make money when you don't have money. The bank made their share of the profit and you made yours. Of course, when you take this formula to the extreme and it's not regulated by the governments and practiced by everyone in the Wall Street, it turns into a financial crisis, as it happened in 2008. Remember when home prices crashed and then they took down the entire economy with them? Well, it's because the investment banks used leverage to maximize their profit to the point where their strategy backfired. Because they began giving mortgages to people who didn't necessarily have the best credit score and weren't financially prepared to make the monthly payments. And then they defaulted on their mortgages, as they suppose. It was a nightmare for the investors, because for the last 40 years, home prices were rising and suddenly they are going down. Well, we're not going to get into the details of the 2008 financial crisis, that's a story for another video, but in any ways, it's a major tool of how rich people make money. Of course, it's risky and you can end up losing everything, but if you know what you're doing, you can make a fortune overnight. Everyone assumes that if you make a lot of money, you must be paying a fortune to the government. But Trump's tax reports left many people confused. How on earth do you make hundreds of millions of dollars but pay nothing in taxes? The answer is long and complicated, but we'll try to simplify it here in this video. Just a disclaimer, I don't want to politicize this video. We're not a political channel. Regardless of which party you affiliate with or which candidate do you support, Donald Trump is a pretty good example of someone who used debt to build his multi-billion-dollar empire. Of course, some of his methods are quite controversial to say the least, but we're not going to look into that. If you make over $600,000, you probably pay over 37% in taxes, and that number could drop if the Democrats pass their tax bill. But as they say, the devil is in the details. If you would have made that $600,000 using debt, you could have lowered your tax rate to 0% or even apply for a tax refund, as Jeff Bezos did with Amazon back in 2018, where Amazon received a federal tax refund of $129 million. If you master debt and real estate, you can use other people's money to make millions of dollars and pay absolutely no taxes at all. Real estate isn't the only industry where you can use debt to make a fortune. Debt is used pretty much everywhere, including the stock market. Let's say you have $50,000 in your bank account and you're looking to trade some stocks. Based on your analysis, you believe that stock A will increase by 10% tomorrow. You can use your $50,000 to buy stock A. And let's assume that your predictions turn out to be correct. Stock A rises by 10%, you immediately sell your stocks for $55,000 and end up making $5,000 in profit. Great! But that's one way to do it. Your second option is margin investing. With a margin account, your broker would loan you an extra $50,000. So now you can buy stocks worth $100,000. If we use the exact same example and assume that you spend $100,000 buying stock A and sell it once it rises by 10%, you end up making $10,000 instead of $5,000. Suddenly, out of nothing, you doubled your income on the exact same deal. You don't have to make a lot of deals to build a fortune. If you're going to be right just once and leverage it, that's enough to make a fortune. That's probably the only shortcut to build wealth. But not everything is sunshine and rainbows. With leverage comes risk. A lot of risks. If the stock price falls below a certain value, your broker has the right to liquidate your stocks and leave you with a loss. So you have to be quite confident about your decision. For those who are not as risk tolerant as some of the other investors, there is an option to leverage ETFs. ETFs usually follow a particular index such as the S&P 500 or a certain industry or bonds. So instead of using debt to purchase a particular stock, you can try ETFs. Of course, ETFs don't usually rise as fast as individual stocks, but they neither fall dramatically since they perform as good or as bad as the industry average. But margin investing isn't as popular as short selling. You probably have heard about this term alongside Tesla, because these two words go hand in hand. While most beginner investors try to make money by predicting which stocks would rise in value, some professional investors make money by predicting which stocks would fall in value. It's not as confusing as it might seem. Stock prices jump up and down for one reason or another. Poor quarterly reports or any other negative news can drive the stock price down. Let's say Apple's stock price is $100, and tomorrow Apple is going to release its quarterly reports. And based on your analysis, it had a bad quarter, so the stock might fall. You borrow 1,000 Apple stocks from your broker and sell them for $100 each, or $100,000 in total. Now, you have $100,000 in your pocket, but you still owe your broker 1,000 Apple stocks. You use that $100,000 you earned yesterday and buy 1,000 Apple stocks for $80,000 since the stock price fell and return them back to your broker. Without using a single dime out of your money, you have earned $20,000 on a fall of a stock. Investors use this strategy all the time, especially with stocks that are more volatile, such as Tesla. That's why whenever you heard the news that Tesla stock has risen, there will always be an investor who will short it. Although on the last occasion, investors lost millions of dollars since Tesla stock kept rising. Elon Musk recently crossed a net worth of $300 billion. That is more wealth than the entire GDP of countries such as Greece, Portugal, or Finland. If he spends $1 million a month, he would need 25,000 years to spend all of that money. Even if he would spend $1 million a day, he will need more than 821 years to spend $300 billion. Imagine how your life would look like if you could spend $1 million a day. Elon Musk is 50 years old. Let's assume he will live for another 50 years. He will have to spend $6 billion every single year, or $16.5 million every single day for the rest of his life to be able to spend all of that money within his lifetime. Can he do it? You can ask him on Twitter. The only problem with this wealth is that it is not real. This wealth only exists on paper. If he tried to turn it into real money, he might end up losing all of his fortune. When the CEO sells off his shares when the company is barely profitable, that can scare off investors. An oversupply of Tesla shares can easily drag the stock price down. On top of that, he will have to pay a 20% capital gain tax, further diminishing his net worth. So, at the end of the day, he is not as rich as he might appear on the Forbes list. But that's not a big deal. When the world's richest man wants some cash, he can simply borrow money by putting up some of his Tesla shares as collateral. Elon Musk can walk into a bank and say, "How about you loan me $100 million? In case if I won't be able to pay back, I will give you the authority to sell my Tesla shares." Since Tesla is booming, the bank isn't taking any risk, so they will loan him as much money as he wants at 1 or 2%. Elon Musk or any billionaire can access their wealth that exists only on paper without paying taxes, since you do not pay taxes on debt. In 2012, he bought his first mansion in Bay Area for $17 million. Back then, Tesla's stock price was just $6. Ideally, he should have sold $17 million worth of Tesla shares to buy that mansion, but instead, he bought the shares as collateral and took a mortgage. Since then, Tesla's stock price has grown by 17,000%, while he only had to pay a 2% mortgage rate. If he had sold his shares, he would have paid a 20% capital gain tax and would have missed the opportunity to grow his shares by 17,000%. Do you realize now why billionaires love debt so much? Here is another strategy. Buy a piece of art for $10 million. Pay some journalists to create a buzz around it. Pay some experts to write about what a great piece of art it is and why it is worth $100 million. Go to a bank, give them your piece of art as collateral, and boom, you can borrow up to $100 million in cash at 1 or 2% interest rate. Now you can buy a mansion, a yacht, or throw a huge party. Just make sure to make the minimum payment when your business generates some cash at the end of the year without selling any of your shares and paying millions in taxes. If you think it ends there, then you have no idea to what extent billionaires love debt. It's the 1990s. The British economy is suffering. Inflation is high, unemployment is rising, and the government is in chaos. Britain had to devalue its currency to survive, but it was part of the ERM, or the European Exchange Rate Mechanism, which fixed all European currencies against each other to prevent currency fluctuations to make it easier for businesses to trade across Europe. The demand for the British pound kept declining as Britain fell into a recession. Hence, the Bank of England had to buy billions of dollars worth of pounds to keep the pound at the same rate as other European currencies. While it was bad news for Brits, it was a billion-dollar opportunity for George Soros. By looking at the numbers, he realized that sooner or later the Bank of England would have to devalue the pound, even if that meant leaving the ERM. Soros was one step away from a gold mine. He went to various hedge funds, borrowed billions of pounds at a very low rate, and then sold them in the forex market in exchange for German marks. The idea was simple: when the British pound will collapse, Soros will buy those pounds cheaper and return them, pocketing the difference. On September the 16th, when the president of the Bundesbank hinted in an interview that it is possible for some currencies to come under pressure, that night when Europe was asleep, Soros began calling all the major banks, or in fact, any bank, to borrow as many pounds as possible. By morning, Soros borrowed and sold over $10 billion worth of pounds. The Bank of England was in absolute disarray. The British pound was collapsing. The Bank of England purchased $27 billion worth of pounds, raised interest rates to 15%. But it was too late already. The entire market began to sell their pounds after Soros' move. Before the day ended, England left the ERM and devalued the pound, and Soros profited over $1 billion. Without spending a single penny out of his pocket, he borrowed billions of pounds, broke the Bank of England, and pocketed $1 billion. Can you really say that that is bad after that? It's 2005. Michael Burry is going through mortgage-backed securities, and he's suspicious. Something unusual comes up. He can't believe his eyes, so he starts digging farther and farther. But the more he digs, the more he's shocked. Every mortgage-backed security is filled with multiple junk loans. In fact, these loans are given on the basis that the borrower doesn't have a deadline to pay the principal. They can even skip the interest on the interest, which meant that even a high school dropout with no job or savings could buy a house. Ideally, the rating agencies would give these loans a C rating, but investment banks pile them together with good loans, and boom, now you have AAA loans. If a small minority of these borrowers will default on their loans, it will drag down the entire market. In 2007 alone, $500 billion worth of these loans were sold. That's when Michael Burry shorted mortgage-backed securities, exactly like Soros shorted the pound. He borrowed as many mortgage-backed securities as possible and immediately sold them in the open market, hoping that when the market will crash, he would be able to buy these securities at a much lower price and return them back. Everyone thought he was crazy betting against the housing market, but this
down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
Michael Burry walked away with a personal profit of $100 million. All of that was done with debt. But not everything is sunshine and rainbows. It's April 2020. Melvin Capital, Citadel, and a few other hedge funds decided to make a few $1 billion by bankrupting another barely surviving company, called GameStop. By that time, the hedge funds had already shorted 140% of the total stocks. More shares were shorted than actual shares in circulation. It was a matter of time before the stock collapses, and hedge funds closed the deal with a few $1 billion for their investors. But something went wrong. A Reddit user realized that the only way these hedge funds can get out of this deal is by purchasing back all of the existing shares. If he purchases GameStop shares and holds them long enough, these hedge funds will pay whatever price you want to buy back the shares, because if they don't, they will keep paying interest since these shares have been borrowed. The Reddit post went viral and everyone began buying GameStop shares to the point where the stock price soared. Hedge funds purchased the stock at $5 to $10, but now had to buy them back at $300 or $400 to give them back. The news broke the internet. Wall Street was in absolute chaos. For the first time, retail investors beat Wall Street at their own game. At this point, the hedge funds knew that if they didn't stop this rebellion, they might go bankrupt. First, they pushed Robinhood to stop selling GameStop shares on their platform. Soon, other brokers followed. Even though they stopped the rebellion, hedge funds ended up losing almost $13 billion in the process. That is a powerful tool, but it's not for everyone. It can be your best friend or your worst enemy. Even if you have hundreds of millions of dollars stashed in your bank account, not a single smart businessman will use that money to grow the business. Instead, let the banks know that you and your companies, for example, actually have the money and borrow the same amount of money to finance your operations. At the end of the year, when it's time to pay taxes, you can claim that you did not make any profit on paper since you owe the bank so much money. Suddenly, instead of paying a 21% corporate tax, you pay nothing. And in case you need money to finance your lavish lifestyle, use the company's fund to pay for your private jet, expensive restaurants, and luxurious hotels, and write them off as a business expense at the end of the year. That's what almost every company does in the US or anywhere else in the world. Here is a simple question. Why would anyone give you millions of dollars when they can use that money for themselves? Why are they wasting it on you? Let me tell you a secret. You have no idea how much money there is in the world. Trust me, the amount of wealth that is there in the world is unimaginable. There are people who have hundreds of billions of dollars in offshore accounts. Officially, there are around 1,000 people with a net worth of at least $1 billion in the United States and 3,311 billionaires worldwide. And this is just the official number. If you have a private business, nobody knows your numbers and nobody can have access to your financial statements. You could be making hundreds of millions of dollars a year and nobody knows. So you could be one of these undercover billionaires. Now, every single day, this enormous wealth is stored in offshore accounts and inflation is eating it up. Apple alone has over $200 billion of cash stored in offshore accounts. So if you can come up with a way and say that you will borrow this money, use it effectively, that you can give them back at 2 or 3% above the inflation rate, they will gladly lend you that money. It's as simple as that. Now, inflation is like 7 or 8 or 9% now, but normally it's about 2 to 3%. So any money you make above 5% is yours. Let me tell you how rich people use debt to make a ton of money. What business do you think when you think of Starbucks? Selling coffees, right? That's what they want you to think. Starbucks is the place you go to get your daily latte. But what if I told you that Starbucks is actually a bank? It's a bank like JP Morgan, Wells Fargo, Citibank, you name it. If you're a loyal Starbucks customer, you probably have the Starbucks app downloaded on your phone. And whenever you pay for your daily caramel latte, you use the app to pay for it because it lets you generate points that you can eventually use to get a free coffee. As much as they want you to believe, making a cup of coffee is cheap. Starbucks is charging you like $6 or $7 per venti frappuccino, but the actual cost is literally pennies. So for them to give you a free coffee once a month because you buy a coffee from them every single day is nothing. But most importantly, you hold your money in their wallet so that you can earn these points. At the end of 2021, users held a collective of $1.5 billion in balances. $1.5 billion might not sound like a huge amount of money, but it's more than what the most banks hold in the US. Starbucks can do whatever they want with that money. Open more stores, invested in real estate, expand their operations across the globe, invested in the S&P 500, trade stocks, whatever they want. They know that you're not going to ask for that money back anyway. In fact, when it's about to be over, you are going to reload your Starbucks wallet for a week or a month. Starbucks built a business that essentially relies on borrowing money from customers with zero interest in return for giving them a cup of free coffee a month. Isn't that genius? Starbucks isn't a coffee company. It's a bank that sells coffee. It can simply lend that money on interest to someone else and live off the interest it will generate out of it, since it pays zero interest to the people who lend the money to Starbucks in the first place, except for a free cup of coffee once a month. That's not the only way the rich people make money with debt. Banks are ripping off the little guys, like you and I. It's us who pay for decades of interest on the student loan we borrow to pay the bills. But the rich only benefit from the banks. Banks are like passive income sources for the top 1%. Imagine you're a wealthy dude. Elon Musk, Mark Zuckerberg, doesn't matter. You have this tech company that is worth like hundreds of billions of dollars. You might own like 10 or 20% of the company. On paper, you are a billionaire, but if you turn around and sell those shares, you will cripple your net worth. It will just crush the stock price, making you poorer, so you cannot do that. So how about using the profits your company generates? Nope, you can't do that either. Your company might earn like billions of dollars, but it has to reinvest that money back into the company. Otherwise, there is like a 30% corporate tax waiting for you. So, what do you do as a tech CEO who owns stocks worth billions of dollars? You go to a bank and ask for $50 million. But instead, the bank will give you $100 million to buy a private jet, a yacht, or a couple of supercars. What are you going to do in return is give your shares to the bank as a collateral. The shares are still yours. The bank can only sell them to get back their money if you won't be able to pay back your debt. So you're fine as long as you make your annual minimum interest payment. The interest on your loan is going to be very small because you are considered to be a high net worth individual, and the chances that you will go broke are very slim. That's why billionaires, even though they have like so much money, they still borrow money to buy their expensive toys. Mark Zuckerberg took a mortgage to buy his Palo Alto home. Elon Musk borrowed money to buy his luxurious mansions in Bay Area. As the price of your shares keeps rising, you keep borrowing more and more, financing your lavish lifestyle while making the minimum interest payment to the bank. And when you finally make a profit, oops, your tax rate is going to be significantly lower because you can deduct all of this interest from your tax payment. It's as simple as that.